Did you know that 90% of retail traders will lose 90% of their funds within their first 90 days? It is a statistic so brutal that the industry calls it the 90-90-90 rule. Most aspiring traders believe they fall into this trap because they lack a secret strategy or a proprietary indicator. They spend thousands on courses hunting for the holy grail of technical analysis. But the charts are not the problem. The math is not the problem. The problem is the organic supercomputer between your ears. Trading is psychologically traumatic. It forces you to confront failure, financial loss, and uncertainty repeatedly, often within minutes. When the pressure mounts, your carefully crafted trading plan evaporates, replaced by raw, unfiltered emotion. We call this collapse trading psychology, but that is too soft a term. It implies a gentle mindfulness practice. In reality, it is damage control. It is disaster mitigation. It is simply tilt management. You are not managing your thoughts. You are managing a biological crisis. But where does this destructive impulse actually come from? Have you ever seen an old pinball machine display the word tilt in flashing red lights and shut down completely? That mechanic was invented to stop players from physically assaulting the machine to influence the ball. The machine sensed the aggression and killed the game to protect itself. In poker, the term was adopted for players who get angry and start playing recklessly. But in the financial markets, there is no censor to shut down the game when you get emotional. The market will happily accept your orders, whether you are calm, furious, or desperate. This is why trading tilt is so lethal. Without an external game over mechanism, you can destroy a decade of savings in a single afternoon of rage. You become the pinball player shaking the machine, but the machine is the global economy, and it does not budge. You are fighting a war you cannot physically win. The tilt mechanism must be built internally, or you will perish. But what happens inside the brain to trigger this total systemic failure? It takes exactly 0.02 seconds for your amygdala to hijack your entire rational decision-making process. This almond-shaped cluster of nuclei in your temporal lobe is the brain's smoke detector. Its job is to identify threats and trigger the fight-or-flight response. In the savannah, this saved you from lions. In the stock market, it saves you from absolutely nothing. When a trade goes against you, the amygdala perceives the financial loss as a physical threat to your survival. It floods your system with cortisol and adrenaline, your heart rate spikes, your blood vessels constrict. Crucially, the connection to your prefrontal cortex, the part of the brain responsible for logic, planning, and impulse control, is chemically severed. You literally become stupider in real time. You are physically incapable of following your trading plan because the part of your brain that wrote the plan has been shut offline. You are operating on pure animal instinct in a game of complex mathematics. But why does a simple red number on a screen hurt so much? Why does losing $100 feel twice as painful as winning $100 feels good? Behavioral economists call this loss aversion, and it is the bedrock of trading misery. Evolution wired us to value holding on to resources more than acquiring new ones, because losing your food supply meant death. In trading, this translates to a toxic inability to take a small loss. You watch a stock dip, and instead of selling to protect your capital, you hold on, you hope, you pray. You cannot bear the pain of realizing the loss, so you defer it. You convince yourself it will come back. This is the first stage of tilt, denial. You are prioritizing your emotional comfort over your financial reality. The irony is that by trying to avoid the small pain of a cut, you expose yourself to the catastrophic pain of an amputation. You are fighting millions of years of evolutionary programming. But what happens when that passive denial turns into active aggression? Have you ever felt a sudden, burning desire to punch the market back after it takes your money? This is revenge trading, the most aggressive form of tilt. After a stinging loss, your ego is bruised. You feel robbed. The market feels personal, like a bully that just stole your lunch money. To restore your pride, you immediately jump back into a trade, often with double the size, to make back what you lost. You abandon your set of criteria. You ignore the trend. You are purely lashing out. The tragedy is that the market is an inanimate object. It does not know you exist, and it certainly does not care about your anger. By trying to force the market to pay you back, you are trading based on what you need the price to do, rather than what the price is actually doing. You are effectively setting money on fire to soothe your ego. And when that revenge trade fails, as it almost always does, where do you go next? If a coin flips heads 10 times in a row, is it more likely to be tails on the next flip? Most people instinctively say yes, but the answer is absolutely not. The probability remains exactly 50-50. This is the gambler's fallacy, and it destroys traders who believe a stock is due for a reversal. When you are tilting, you look at a plummeting chart and think, it has fallen too far. It has to go up now. You start catching falling knives. You buy the dip, and it dips lower. You buy again, convinced the laws of the universe owe you a bounce. You are imposing a narrative of balance onto a chaotic system that can remain irrational far longer than you can remain solvent. You assume the market seeks equilibrium, but often it seeks momentum. Relying on the idea that a trend must end is not analysis. It is a delusion born of desperation. But sometimes the tilt doesn't come from losing money, but from missing it. Did you know that watching others get rich triggers the same part of the brain as physical pain? Fear of missing out, or FOMO, is a potent form of tilt that strikes when you are sitting on the sidelines. You see a green candle rocket upwards. Social media is screaming about new highs. You feel like the train is leaving the station without you. Panic sets in. You abandon your entry rules and buy at the very top, driven by the terror of being left behind. You are not buying value. You are buying relief from your anxiety. FOMO tilt makes you chase extended moves, entering exactly where the professionals are exiting. You become the greater fool, providing liquidity for the smart money. It is a desperate grasp for inclusion that usually results in immediate drawdown. You bought the hype, and now you own the bag. But surely, making money solves all these psychological problems, right? Actually, winning can be even deadlier. Why do casinos offer free drinks to players who are on a winning streak? Because they know that confidence is the most dangerous drug of all. Winner's tilt, or euphoria, happens after a string of successful trades. You feel invincible. You start to believe you have solved the market. You think you have a golden touch. This chemical high makes you sloppy. You stop checking your risk parameters. You increase your position sizes significantly, thinking you are playing with house money. But there is no such thing as house money. It is your capital now. The market has a cruel way of humbling the arrogant. Overconfidence leads to over-leveraging, and one inevitably bad trade wipes out the gains from the previous 10. You give it all back, plus interest, because you forgot that your winning streak was a statistical probability, not a divine right. The crash from euphoria to despair is swift. And when the dust settles, you are left with the most pathetic form of tilt, desperation. What happens when you are trading not to build wealth, but to pay next month's rent? You enter the zone of desperation tilt. This occurs when you attach an external financial necessity to your trading performance. You need the market to generate $500 today for a bill. You are now trading with scared money. The pressure paralyzes your judgment. You take profits too quickly because you are terrified of them vanishing. You hold losses too long because you cannot afford to be wrong. You force trades where there is no edge because the clock is ticking. The market senses this fear. Volatility that you would normally withstand shakes you out of good positions. You are trading your P&L, not the chart. The added weight of financial obligation destroys the objective mindset required to execute a strategy. You cannot perform surgery with a gun to your head. But even if you don't need the rent money, you might fall into the trap of trying to fix a simple mistake. How many times have you bargained with the trading gods, saying, "Just get me back to break even, and I'll close the trade"? This is the break-even tilt. You are in a bad position, drowning in red. Instead of cutting the loss and accepting the mistake, you move your take-profit order to your entry price. You are desperate to erase the evidence of your failure. You want a moral victory of a scratch trade. The market might retrace halfway, offering you a chance to exit with a small, manageable loss. But you refuse. You stubbornly wait for that specific break-even number. The price hits resistance, rolls over, and crashes to new lows. By refusing to pay a small tuition, you incur a total loss. You held out for a psychological wash instead of making a logical salvage decision. You valued your ego's need to be not wrong over your account's need for capital preservation. But sometimes, the fear of being wrong stops you from doing anything at all.
Is it possible to know so much that you can't do anything? Analysis paralysis is the tilt of hesitation. You have 5 monitors, 10 indicators, 3 news feeds, and a chat room open. You see a setup, but one indicator looks slightly bearish, while another is bullish. You freeze. You wait for more confirmation. You want absolute certainty in a probabilistic environment. While you dither, the move happens. You watch the price fly to your target without you. Now the second layer of tilt hits, regret. You beat yourself up for being a coward. You swear you will take the next one. So you jump into the next setup impulsively to prove you are decisive, but that setup is subpar and you lose. Paralysis leads to forced action. It is a cycle of fear-driven inaction followed by regret-driven recklessness. You are drowning in data but starving for wisdom. But your body usually warns you before any of this happens, if you know how to listen.
Did you know your palms start sweating milliseconds before your conscious brain realizes you are under stress? Your body is the ultimate early warning system for tilt. Before you smash the mouse button in anger, there are physiological signs. Your breathing becomes shallow and rapid. Your jaw clenches. Your shoulders hike up to your ears. You might feel a pit in your stomach or a heat flush in your face. These are the biological signatures of the fight or flight response initiating. Most traders ignore them. They stare blankly at the screen, disconnected from their physical selves. If you can learn to recognize these somatic markers, you can catch tilt in its incubation phase. You can stop the hijack before it completes. The moment you feel that heat or that tension, you must treat it like a check engine light. It means you are no longer fit to drive. But what do you do when the light comes on? You need a mechanical failsafe.
Why does the New York Stock Exchange have circuit breakers that halt all trading during a crash? Because the regulators know that mass panic is irrational and destructive. They force a timeout. As a trader, you need your own personal circuit breakers. This is the hard stop. It is a non-negotiable rule that removes you from the terminal. For example, if I lose 3 trades in a row, I am done for the day. Or, if I lose 2% of my account, I close the platform. This rule must be absolute. It is your ejection seat. When you are tilting, you will not want to stop. You will want to fight. That is why the rule must be decided before the session begins, when you are sober and rational. The hard stop protects you from your future self. It acknowledges that you are fallible and that there are days when you are the pigeon, not the statue. But stopping is only the first step. You must then reframe the failure.
Is a trading loss a sign of personal incompetence, or is it simply the cost of goods sold? How you answer this determines your susceptibility to tilt. In any other business, spending money to make money is normal. A restaurant buys food, expense, to sell meals, revenue. They don't scream at the vegetable supplier when they pay the invoice. In trading, a losing trade is your inventory expense. It is the operating cost of the business. If you view every loss as a personal attack on your intelligence, you will tilt every time. You must reframe the narrative. A loss is not a failure. It is information. It is a fee paid to the market for the opportunity to find the next winner. When you detach your self-worth from your P&L, a red trade is just data. It has no emotional charge. But to truly internalize this, you need to stop looking at one trade at a time.
Do you think a casino pit boss gets angry when a player hits a blackjack? Absolutely not. The casino does not care about the outcome of a single hand. They care about the outcome of 1,000,000 hands. They know the math is rigged in their favor over the long run. This is the probability mindset. Traders tilt because they obsess over the micro outcome of the current trade. They forget the macro edge. If you have a strategy with a 60% win rate, you will still lose 40% of the time. That means out of 100 trades, 40 will be losers. Losing is a mathematical certainty, not an anomaly. When you think in probabilities, a loss is just a statistical variance, a necessary step toward the aggregate profit. You stop judging your success by the result of the last 5 minutes and start judging it by the execution of the last 5 months. But how do you maintain this perspective in the heat of battle?
Why do algorithmic trading bots never smash their keyboards? Because they operate on binary logic. If X happens, do Y. They have no ego, no rent to pay, and no fear of looking stupid. While you cannot become a robot, you can make your strategy robotic. The antidote to emotional tilt is mechanical rules. Eliminate discretion wherever possible. Define your entry, stop loss, and take profit targets with rigid precision before you enter. If your strategy requires you to feel the market, you are opening the door to tilt. Feeling is just a hiding place for bias. By systematizing your edge, you outsource the decision-making to the plan. You become an executor, not a decider. Your only job is to press the button when the criteria are met. The less you have to think during the trade, the less you will feel. But even the best systems fail if you don't track the data.
Have you ever looked at a simulated equity curve of a profitable strategy? It is never a straight line up. It is jagged, it has peaks, and terrifyingly, it has valleys. These valleys are called drawdowns, and they are inevitable. Most traders tilt because they have unrealistic expectations. They expect a salary-like consistency from a chaotic market. When the inevitable drawdown hits, they panic and assume their strategy is broken. They start tweaking rules or strategy hopping, which is the fastest way to ruin. If you understand that your edge includes periods of stagnation or decline, you won't freak out when they happen. You will recognize the drawdown as a normal part of the cycle, just like winter is a part of the year. You just have to survive the winter to reap the harvest. To do that, you must become a scientist of your own behavior.
You probably track your entry price, exit price, and profit. But do you track your heart rate? Do you track your mood? If not, your trading journal is incomplete. You cannot fix a leak you cannot see. You need to start an emotional journal. Note down how you felt before, during, and after every trade. Were you bored, anxious, overconfident, angry? Over time, you will see patterns. You might realize you always lose money on Fridays when you are tired, or that you always tilt after a trade that stops you out by one tick. This data allows you to identify your personal tilt triggers. Once you know your triggers, you can build defenses against them. You move from being a victim of your emotions to being an observer of them. But sometimes the best defense is simply cleaning up your room.
Is your trading desk a sanctuary of focus, or is it a chaotic mess of coffee cups, unpaid bills, and distractions? Environment dictates performance. If your physical space is cluttered, your mind will be cluttered. External stressors lower your threshold for tilt. If you're interrupted by a phone call, or you are uncomfortable in your chair, your patience wears thin. You snap. You make a rash decision. Professional traders treat their environment like a cockpit. Everything is ergonomic, clean, and silent. They eliminate friction. They turn off phone notifications. They close the door. By controlling your external environment, you preserve your limited reserve of willpower for the market. You are reducing the cognitive load so that when the market throws a curveball, you have the mental bandwidth to handle it calmly. But even in a perfect room, the most dangerous enemy is the urge to do too much.
Jesse Livermore, one of the greatest traders in history, said, "It was never my thinking that made the big money for me. It was always my sitting." Overtrading is a classic symptom of boredom tilt. You feel that to be a trader, you must be trading, so you invent setups where there are none. You click buttons just to feel involved. This is fatal. The market does not pay you for effort. It pays you for being right. Cash is a position. Standing aside is a trade. The ability to sit on your hands for 3 days and do absolutely nothing because your setup is not present is the hallmark of a professional. It is the sniper mindset versus the machine gunner mindset. The sniper waits for the perfect shot. The machine gunner sprays and prays, running out of ammo before the target appears. But how do you cultivate that level of patience? Can a simple breathing exercise save your portfolio? Surprisingly, yes. When you tilt, your nervous system shifts into sympathetic dominance, fight or flight. To regain access to your logical brain, you must force a shift back to the parasympathetic nervous system, rest and digest. The fastest way to do this is through the breath. Deep, rhythmic breathing physically signals to your brain that you are safe. Box breathing, inhale 4, hold 4, exhale 4, hold 4, is used by Navy SEALs to stay calm in combat. It works just as well when the S&P 500 is crashing. By taking a literal breather, you create a gap between the stimulus, the market move, and your response, the mouse click. In that gap lies your freedom. In that gap, you can choose to follow your rules instead of your impulses. But ultimately, you must accept what you cannot control.
The ultimate cause of tilt is the illusion of control. You think that if you analyze hard enough, you can control the outcome. When the market defies you, you feel a cognitive dissonance that manifests as rage. You must surrender. You must accept that the market is a chaotic, infinite ocean of divergent opinions and algorithms. You cannot control the price. You cannot control the news. You cannot control the Fed. You can only control 2 things: when you get in and when you get out. That is it. Everything else is noise. When you truly accept the uncertainty of every single trade, you cannot tilt because you had no expectation of certainty to begin with. You surrender the need to be right and replace it with the need to be disciplined. But this requires a fundamental shift in who you think you are.
Are you an amateur gambler hoping to get lucky, or are you a professional risk manager operating a business? The amateur wants excitement. The amateur wants to be right. The amateur takes every loss personally. The professional is bored. The professional focuses on execution. The professional views capital as a tool, not a scoreboard of self-worth. To master tilt, you must undergo an identity shift. You must stop identifying as a trader who needs to win battles and start identifying as a manager who adheres to policy. When you make this shift, a loss is no longer a reflection of your character. It is just a reflection of the market conditions. You stop trying to prove yourself to the screen. You simply do your job. And when you finally reach this state, you realize the ultimate truth about the market. The market is the most expensive mirror you will ever buy. It reflects every insecurity, every fear, and every flaw in your character right back at you in real time. If you are greedy, it will destroy you. If you are fearful, it will freeze you. If you are arrogant, it will humble you. Trading psychology is not about learning to read charts. It is about learning to read yourself. It is about mastering the internal demons so they do not manifest as external losses. We called it tilt management, but really, it is self-management. If you can conquer the tilt, you have conquered the self. And if you can conquer the self, the market is no longer an enemy. It is just a stream of opportunity. The charts never change. The strategy is simple. The only variable is you. So ask yourself one final time, are you ready to stop fighting the market and start mastering the mirror? The choice is now yours.